The term pay for performance is often used interchangeably with the term variable pay because this type of compensation moves pay from being a fixed cost to one that varies with employee performance. Variable pay is compensation that's tied to performance. Incentives are tangible rewards that encourage or motivate action and therefore might be related to pay or be even broader. A pay-for-performance philosophy differs from a traditional entitlement compensation philosophy in which the difference in length of service is often the primary differentiating factor. Variable pay plans are designed to motivate employees to invest discretionary effort, the extra over and above minimum needed to avoid getting fired. The philosophical foundation of variable pay rests on three basic assumptions. First, some people or groups contribute more to organizational success than do others. Second, some people perform better and are more productive than are others. And third, employees or groups who perform better or contribute more should receive greater compensation. There is evidence that variable pay broadly available to most employees does not improve company performance. However, not everyone wants to have their pay contingent on their performance. Research has shown that intrinsic rewards, or rewards that are internal to the individual, are more powerful in motivating workers to exercise discretionary effort to achieve their own and the organization's goals. Intrinsic rewards include meaningful work, autonomy, professional development, and opportunities to use their expertise. Employers adopt variable pay for many reasons, including the following: to link strategic business goals and employee performance, to enhance organizational results and reward employees financially for their contributions, to recognize different levels of employee performance through different rewards, to achieve HR objectives such as increasing retention, reducing turnover, recognizing succession training, and rewarding safety, and finally, to reduce fixed costs. Given these dynamics and the complexity of some plans, providing effective variable pay requires significant ongoing effort. Incentive plans are most successful if they follow these guidelines. Develop clear, understandable plans that are continually communicated, use realistic performance measures, keep the plans current and linked to organization objectives, clearly link performance results to payouts and recognize performance differences, and finally, identify variable pay incentives separately from base pay on paychecks. Variable pay plans can be considered successful if they fit the organization's objectives, culture, and financial resources. Key performance indicators, known as KPIs, are the scorecard measures that tell managers how well the organization is performing relative to the critical success factors. For example, if attracting and retaining profitable customers is a critical success factor, then the key performance indicator might include measures such as customer loyalty scores, repeat business, and customer referrals. Key performance indicators can be determined at various levels of performance: the individual, the work unit or group, or the overall organization. By selecting the most useful KPIs and tying them to rewards, an organization can best move employees towards performance that will really make a difference in outcomes. Under a straight piece rate system, wages are determined by multiplying the number of units produced, such as garments sewn or service calls handled, by the piece rate for each one unit. Piece rate systems determine employee pay based on the level of output produced or work completed. Not everyone responds to the same piece rate systems. Some work hard to make more money, others do the minimum. When workers are paid with a piece rate system, inequity in pay naturally occurs. This inequity can lead to dysfunction within a work group, so training managers in the program specifics is helpful. A differential piece rate system pays employees one piece rate wage for units produced up to a standard level of output, and a higher piece rate wage for units produced over the standard. Managers can determine the quotas or standards by using time or motion studies. Despite their incentive value, piece rate systems can be difficult to apply because determining appropriate standards can be a complex and costly process for some types of jobs. In some instances, the cost of determining and maintaining the standards may be greater than the benefits derived. Individual employees may receive additional compensation in the form of a bonus, which is a one-time payment that does not become part of the employee's base pay. A bonus can recognize performance by an employee, a team, or the organization as a whole. When performance results are good, bonuses go up, and when performance results are not met, bonuses go down or disappear. However, according to recent research, 24% of companies award incentive payouts to employees who have not met performance expectations. Undermining the incentive potential of bonuses is a serious problem because it sends the wrong message to employees. Recommendations to rein in this counterproductive management behavior include the following. Establish clear, metric-based employee reviews. Performance levels should be clearly stated and aligned with other reward and recognition programs. Ensure that employees who have not met performance criteria do not receive a payout. Educate managers and employees about the incentive plan details, and make sure that employees understand how their performance will be evaluated and rewarded, and that managers have clear guidelines for determining award levels. A unique type of bonus is the spot bonus, so called because it can be awarded at any time. Spot bonuses are given for many reasons, perhaps for extra time worked, extra effort, or work on an especially demanding project. For instance, a spot bonus may be given to an information technology employee who installed the computer software upgrade and required extensive time and effort. Some common examples are referral bonuses, given for referring someone who's later hired, and hiring bonuses, given when someone agrees to hire on with the firm. Retention bonuses are used to keep a valuable employee with the company, and the project completion bonus is given upon completion of a difficult project. In reality, employees may receive bonuses for almost anything noteworthy. A non-monetary reward can consist of almost any material object. It is compensation given in a transaction which does not involve cash. Although such special programs can be developed for groups and for entire organizations, they often focus on rewarding individuals. Advocates for non-monetary incentives hold that there is a growing acceptance of non-cash compensation for recognition purposes. In fact, they argue that recognition from an employee's manager may be highly valued, including simple good mornings and thank yous. However, research suggests that while non-monetary incentives may have intrinsic motivating properties, employee perceptions of these rewards are influenced by several factors such as pay equity, organizational justice, and managerial discretion. Merchandise, gift certificates, and travel are most frequently used incentives for performance awards. Cash is still highly valued by many employees because they can decide how to spend it. However, non-cash incentives may be stronger motivators in some cases, according to a study that considered awards such as vacation cruises, home kitchen equipment, groceries, and other non-cash items. Another type of program recognizes individual employees for their work. Recognition awards often work best when given to acknowledge specific efforts and activities that the organization has identified as important. Another type of reward given to individual employees is the service award, typically given to recognize and reward longevity with the organization. Individual-level incentives are most effective when each employee's performance can be identified, isolated, measured, and rewarded. In many of today's organizations, teams are the primary work unit, and output is often accomplished through combined efforts of several employees. As the name implies, profit sharing is a system to distribute a portion of organizational profits to employees. The primary objectives of profit-sharing plans can include the following: improve organizational results, attract or retain employees, improve product or service quality, enhance employee morale, and focus employees on organizational goals and objectives. Typically, the percentage of profits distributed to employees is established by the end of the year before distribution, although both timing and payment levels might be determined later. Employees must trust that management will accurately disclose profit and other financial information. The definition and level of profit can depend on the accounting system used and on good and bad decisions made by those in top leadership roles. To be credible, management must be willing to disclose sufficient operational and financial information to alleviate the skepticism of employees, particularly if profit-sharing levels fall from those of previous years. If profit-sharing communication is done well, employee pay satisfaction and commitment can be improved. When implementing a profit-sharing plan, organizations should pay special attention to how well it's explained to employees and how open leaders are about the organization's financial performance. A stock option plan gives employees the right to purchase a fixed number of shares of the company's stock at a specified exercise price for a limited period of time. If the market price of the stock exceeds the exercise price, employees can then exercise the option and buy the stock. The number of firms giving stock options to non-executives has declined in recent years, primarily because of changing laws, accounting regulations, and shareholder opposition. Firms in many industries have an employee stock ownership plan, known as an ESOP, which is designed to give employees significant stock ownership in their organizations. Establishing an ESOP creates several advantages. Primarily, the organization can receive favorable tax treatment on the earnings earmarked for the use of the ESOP. Another is that the ESOP gives employees a sense of ownership so they can make decisions that will benefit not only themselves, but also the organization. This can result in employees feeling that they share in the growth and profitability of their firm. Employee ownership may motivate employees to be more productive and focused on organizational performance. Many people approve of the concept of employee ownership because it provides employees with a voice in important matters regarding company operations and decisions. However, ownership can also be a disadvantage for employees because their wages, salaries, and retirement benefits depend on the performance of the organization. Sales compensation programs can effectively drive the behavior of sales representatives, especially if the sales performance measures are based wholly or mostly on sales volumes and revenues. Sales compensation plans can be of three general types: salary only, straight commission, and salary plus commission. Each type of sales compensation has some associated challenges, which are discussed in the following sections. Some organizations pay salespeople only a salary. The salary-only approach is useful when an organization emphasizes serving and retaining existing accounts over generating new sales and accounts. This approach is also frequently used to protect the income of new sales representatives for a period of time while they're building up their clientele. Generally, the employer extends the salary-only approach for new sales representatives for no more than 6 months, at which point a results-based approach is adopted. Salespeople who want additional rewards often function less effectively in salary-only plans because they're less motivated to sell without additional performance-related compensation. A commission is a percentage of the revenue that's generated by sales that's given to an agent or salesperson. As such, a commission represents a potential incentive for employees who qualify. Tips can be similar, even though they're paid by the customer rather than the employer. A straight salary has no additional commission incentive, while a straight commission has all compensation tied to the incentive. Determining the best mix of salary and commission to fit a situation is one of the decisions compensation managers must make. In the straight commission system, a sales representative earns a percentage of the value of the sales generated. Consider a real estate agent selling homes who receives no compensation if he or she doesn't sell a home, but who receives a percentage of the selling price for a home that's sold. The advantage of this system is that it requires the sales representative to sell in order to earn. The disadvantage is that it offers no financial security or predictability for the sales staff. To offset this insecurity, some employers use a draw system in which sales representatives can draw advance payments against future commissions. The amounts drawn are then deducted from future commission checks. Arrangements must be made for repayment of drawn amounts if individuals leave the organization before earning their draws in commissions. The form of sales compensation used most frequently is salary plus commission, which combines the stability of a salary with the performance aspect of a commission. A common salary to commission split is 80% to 20% or 70% to 30%, although the split varies according to industry and numerous other factors. Firms need to thoroughly analyze their sales compensation costs, Assess how sales pay is influencing employee performance efforts, and then evaluate the extent to which sales and profit goals are being met. Effective administration of compensation plans affect how well the plan drives the desired performance of salespeople. Many plans are multi-tiered and can be very complex. Internet-based software has helped employers administer programs and post results daily, weekly, or monthly. Salespeople can use this information to track their results. Administering increases globally is difficult, but HR technology has helped as incentive management software has become more widespread. The development of software systems to measure and record such factors has been important in helping support and manage global sales forces more effectively. Effective design of sales compensation requires establishing clear performance criteria and measures. Generally, no more than 3 sales performance measures should be used in a sales compensation plan. Significant efforts are needed to establish and maintain effective sales incentive plans. The average chief executive officer in the United States earns much less than those who head the Fortune 100 companies. In fact, the Bureau of Labor Statistics reports that for the 250,000 CEOs in the United States, annual average salaries are approximately $200,000 a year. Executive compensation refers to the financial payments and non-monetary benefits provided to high-level management in exchange for their work on behalf of the organization. At the heart of most executive compensation plans is the idea that executives should be rewarded if the organization grows in profitability and value over a period of years, and be penalized if the executive fails to produce positive results. Traditionally, companies have looked to other organizations in the same or similar industry and of a similar size as competitors to determine what level of executive compensation should be. A potential downside of using this method is that CEO compensation trends to ratchet up as each company tries to pay its CEO above the average. A provision of the DODD-FRANK Act requires public corporations to allow shareholders to vote on the presumed fairness of pay packages for the CEO and the other 4 highest paid executives in the organization. The company's leadership team is not required to accept the shareholders' decision, so while it may seem that shareholders have some say on pay, their opinions fall on sometimes deaf ears. The main benefit of the law is increased transparency about how executives are compensated. The clawback provisions of the Sarbanes-Oxley and Dodd-Frank Acts allow for the recovery of incentive-based pay that was provided to executives and later determined to have been paid under false pretenses. For example, employee misconduct and restated earnings may be discovered sometime after incentive payments have been made. The Securities and Exchange Commission can demand repayment from an executive if such a case is proven. Executives are often interested in compensation and the mix of items in the total package because it affects the amount of actual value after taxes. The type of job, the size of organization, the industry, and other factors all influence executive salaries. In some organizations, particularly nonprofits, salaries often make up 90% of total compensation. In contrast, in large corporations, salaries may constitute less than half of total executive compensation packages. Executive salaries are reviewed by boards of directors to ensure that their organizations are competitive. Many executives are covered by regular benefit plans that are also available to non-executive employees, including retirement, health insurance, and vacation plans. In addition, executives may receive supplemental benefits that other employees do not receive. In addition to the regular benefits received by all employees, executives often receive prerequisites or perks, which are special benefits, usually non-cash items. Many executives value the status enhancement of these visible symbols, which allow the executives to be seen as very important people both inside and outside their organizations. Perks can offer other substantial tax savings because some of them are not taxed as income. Annual bonuses for senior managers and executives can be determined in several ways. One way is to use a discretionary system whereby the CEO and board of directors decide bonuses. The absence of formal, measurable targets may detract significantly from pay-for-performance elements of this approach. Another way is to tie bonuses to specific measures, such as return on investment, earning per share, or net profit before taxes. To ensure that executives look beyond the immediate future when making critical decisions, executives' performance-based incentives should tie compensation to the long-term growth and success of the organization. However, whether these incentives really emphasize the long term or merely represent a series of short-term successes is uncertain. Short-term rewards based on quarterly or annual performance may not result in the kind of long-run oriented decisions necessary for a company to perform well over many years. Executives frequently receive a stock option that gives them the right to buy stock in the company, usually at an advantageous price. In addition to standard stock options, many executives are granted restricted stock options. A restricted stock option indicates that company stock shares will be paid as a grant of shares to individuals, usually linked to achieving specific performance criteria. The purpose of providing these equity awards is to encourage executives to think like owners and make business decisions that are in the firm's best interests. While severance packages and pension payments may not ordinarily make the headlines, special executive compensation for separation agreements and payouts as the executive is leaving are controversial. The payouts occur right at the time that people are often unhappy with the executive and may appear unfair. A compensation committee, which is a subgroup of the board of directors, generally has the authority over executive compensation plans. In addition, shareholders of public corporations have the right to vote on executive pay packages.